In this video, I am going to show you how I made over $1 million investing with options. My goal is to share my experience, the do's and don'ts, and to provide as much value as possible so that you can benefit and succeed in this crazy world of finance. Let's get started. Ladies and gentlemen, welcome back to Pandrea Finance. My name is Alex Pandrea, and in this video, I want to talk to you about the steps that I took that led me to make over 7 figures using options. Now, even though I use options as my investment strategy, I think it's important that we all learn a few things before jumping into that first investment, because trust me, if we don't learn a few things first, things might not go as smooth as we would like them to. I mean, not that I know from personal experience or anything. So we should know a few things before we start and then jump into the juicy details. Now, before we jump into it, I am well aware more than anybody that luck played a bit of a role in my investment success, especially with this last year. I mean, do you remember last year? Market nearly crashed 50%? Yeah, I remember last year. But there's an old saying, the harder you work, the luckier you get. And the more you know, the more you practice at anything, the luckier you're gonna get, it seems. I don't know it all by any means, but what I can do is show you what I do know and what you must know if you want to make a bit of money. I am not a financial advisor. I am not telling you how to invest or what to do with your money. I am just here to show you what I did and the plan that I made for myself. This video is going to be broken up into 6 steps. The first 3 steps, we are going to talk about what you must know before even going into any sort of investment. Do not skip this part, as this will build the foundation of any investment that we make, not just in options. Next, we'll go into the following 3 steps where we're going to concentrate on more of an investment strategy, particularly the investment strategy that I followed along the way while making my investments. At the very end, I will give you my number 1 tip, a bonus tip, if you will, which in my opinion is worth the price of this whole free video, so make sure to stay tuned till the end for that. Please consider subscribing to this channel if you think you'll like my content, and without further ado, let's just jump straight into the video. Alright, step number 1, knowledge and understanding. Now, first things first, you gotta understand what you're doing. Now, I know that sounds pretty straightforward and obvious. It's like, thanks Alex, wow, great first tip. Would have never thought of that myself. But let me explain what I mean by that. See, for anything that you do in life, it's very important to understand everything about that subject, but not only just sort of memorize it like you would do in school, right? Remember going to take exams and you'd be like, I just gotta memorize this or memorize that. But then do we actually learn anything? Can we explain it to somebody else? See, to get to the heart of it and to really lay in the groundwork so it stays up in here, you have to understand it fully from the inception before diving headfirst into it. And especially if we're talking about money, right? So let's say you want to start investing in the stock market and you think to yourself, well, I understand that if I put my money into a company's stock can go up and I make money, a company stock could fall and I lose money. But I think that you really have to understand the heart of what it means to invest. So things like how the economy works and what makes a stock price fall and rise. Now, taking that a step further with options, for example, it's really important to know more than just what's a call, what's a put, how you buy them and sell them on Robinhood. You'll have to understand things like volatility, option premium prices, intrinsic value, extrinsic value, Theta Decay, and all those nasty little Greeks. No, not Greeks like the Greeks, these Greeks. Now, if all of that sounded like a foreign language to you, don't worry, it did to me as well, I promise you. But I took my time, I learned as much as I could, and I understood basic concepts fully before I made my first investment. So my suggestion to you, step number 1, understanding, knowledge, get as much as that as possible before we jump into the next step. Step number 2, make a plan for your investment. Make a plan, it's that simple. Every great investor and trader in history had a plan, and anybody worth learning from didn't just wing it. They had a plan and you need one too. Now, when you're just starting out, you're not gonna know exactly what your plan is from the very start. You have to start getting comfortable with certain investments that you're going to make, or rather, should I say, uncomfortable enough, like in my situation, many times, to say to yourself, oh, I like this strategy, or I don't like this strategy, I'm never doing it again. So you can slowly learn what is right for you and create that plan for yourself. So for example, maybe part of your plan is to always sell if your investments drop by 20% or 10% depending on your risk tolerance, right? Maybe part of your investment is to always sell out of your position when you're up 50% profit, right? Maybe part of your plan is to invest in low cap stocks with high potential.
Huge upside potential.
Or maybe it's higher cap stocks with less risk. Or maybe part of your plan is to never invest more than 5% of your capital into one idea, into one trade. This is something that I try to follow myself. All these things, I can't tell you what's right for you, right? You have to figure that out for yourself. And this will come through time, through experience, through your comfort level. So you don't have to know exactly what your plan, what the most successful plan for yourself will be, but regardless, you have to make a plan so you can stick to something, and I think that's going to make you a lot more successful. So that's step number 2, make a plan, don't just wing it.
This has nothing to do with learning options trading.
But it's so cute. Step number 3, risk time. See, everybody knows the old saying, hey, don't invest more than you're willing to lose. And even though, yes, of course, that's a fair statement, when we think of willing to lose, we think of money, right? How much money are we willing to lose? But I want to start thinking about it in a slightly different way. I want you to start thinking, instead of using money as your capital for your investments, use time as a capital for your investments. And this is something that I started to do with, I think, a lot of success, for at least putting in perspective my risk and what I am willing to lose. So you have to ask yourself, how much time, so if I make an investment, how much time am I losing in that investment, and how long will it take? Let's say I lose it all, I make a dumb move, as sometimes I usually do. I make a dumb move. How much time would it take me in my day job, in my business, to make that investment back? See, when you start looking at it as time instead of money, you can put it into perspective, I think, a little bit better. So for example, if you were making $5,000 a month and you want to go and put $5,000 into some investment, you have to think to yourself, am I willing to lose the month of work that it took me to make this $5,000? And let's say I lose it, I have to work again another month to sort of make that back. You have to ask that question for yourself. And maybe it's not the full month. Maybe it's just a week of whatever you make. Maybe it's, 2 months if you're a little bit more risque. For me, I started thinking of it in this way, and I said to myself, I am willing to risk a month because I know that I can make that money back in a month. For whatever reason, I lose it, right? So through that thinking, I established my risk tolerance compared to time and the amount of time that it takes me to make a certain amount of money. You could take that a step further, look at your yearly salary and see what percentage of that yearly salary you invest, or you lose, or you gain, because this goes the other way too. If I'm up a certain percentage, think to yourself, oh, that's a month's salary, this is 2 months' salary. Now look, you won't know exactly your risk tolerance that first time you make an investment, and when you actually start risking that money and risking that time. So one quick tip is to start small, and when you start pushing your limits and feeling uncomfortable, if you feel uncomfortable, then you know that you're almost at that peak of what your risk tolerance is. Everybody is different. Take your time, ease into it, and I think you'll be a lot more successful when looking at it this way. All right, let's get into some juicy details from my strategy. This is step number 4, undervalued companies. So as you might have seen in one of Andre Jick's earlier videos from a few years back, he actually encouraged me to open up a Robinhood account, and I funded that account with $16,000. Now, even though I had a TD Ameritrade account for long-term investments since I was 20 years old, I figured this was a nice way to become a more active investor with this fun new app. Little did we know what Robinhood would turn into these next few years. Am I right? Over the next year or so, I invested more money into Robinhood and my portfolio grew, and I would save and invest about 10% of what I was making from my business into Robinhood until I had about a little over $100,000. Now, during this time, I started learning as much as I could about options and, that first step that we talked about, knowledge and understanding. And the strategy I started to use is trying to find undervalued companies. Companies that, for whatever reason, had a downturn or they were beat down in my opinion, more than they should have been. Now, of course, we could talk about how to value these companies for hours on end, and I promise we're gonna get to everything in this channel, so do subscribe if you haven't already. I started taking a look at strong companies that took a nice dip, and I started buying out of the money calls where the strike price was equal to what the stock price was before the dip. I also chose an expiration date that was at least 2 years out. So for example, let's say MGM stock was at $30 and it dipped down to $15. Okay, this is just an example. Then I would buy out of the money call options 2 years out with the strike price of $30, the price of where the stock was before the dip. And basically what I'm saying is I'm going to give this stock 2 years to recover back to its original price of where it was. Now, of course, this is an oversimplified version. There's a few other things that you need to know, but that's the basic idea. So I had around $100,000 in when I started using this strategy, and I had pretty good success. I mean, the whole year of 2019 was pretty much a bull run. So again, whether that was luck is still debatable, but everybody's a genius in a bull run, huh? But then the pandemic hit, and boy, oh boy. You're trying to look for undervalued companies? Well, look no further. I felt like one of those Mr. Beast videos where you have to carry as much as you can. So I just had to ask myself a very simple question. Which companies are undervalued? And my answer was pretty simple. I'll take them all, please. So I started buying out of the money call options on these undervalued stocks with an expiration date of 2 years out, so given it 2 years to recover, and the strike price, I put it what the price was of the stock before the dip, okay? So around March 2020, take a look at where that top was. We had a big downturn, and that price before the dip would be my strike price. And now here we are, 10x later. So that's step number 4, find undervalued companies. Step number 5, asymmetrical returns. Most people think that in investing you have to take huge risks to become rich, but that's rarely the case. See, some of the most successful traders and investors take the least amount of risk possible, but with the most potential upside. So if we were to take a look at something like derivatives, like options, for example, we understand that there's leverage in there to increase your returns than there would be in just the regular stock market. So a lot of times when a company's stock goes up 10%, the option prices can go up 50%, 100% even, or more. And the idea of this strategy is not to throw everything that you have into one trade or one investment and try to double or triple your money fast. Like I know some of you try to do, and you see it all the time, right? I want to double my money. I want to 10x my money. And you throw the whole kitchen sink at the investment. That's not how to do it. What you want to look at is investing a fraction of your portfolio, but with the potential for asymmetrical returns to 2x, 3x, 5x your money. If we take a look at one of my favorite traders or investors of all time, Paul Tudor Jones, he speaks about this concept all the time. You risk $1 to make 5. This is a safe but aggressive way to look at investing. It's somewhat safe because we're not taking everything we have and YOLOing it into rocket emojis and whatever the popular thing may be. But it's aggressive because we're going for bigger returns. So if I risk $1 to make 5 and I'm wrong, then I have another 4 times basically to try to break even, if that makes sense. I could be wrong 4 out of 5 times and still break even. And these are the type of investments that I try to look at, and these are the type of investments that I looked at when I took a look at option pricing and the potential enhanced returns of options. And if you've been following the previous steps until now, you're not going to be wrong 4 out of 5 times. It's less likely that you will if you go through and know what you're doing, look for undervalued companies, go for asymmetrical returns. You will start making money. Step number 6, don't get greedy, but get greedy. See, I know a lot of people say, oh, don't get greedy while investing. And while yes, this is true, we should distinguish the different types of greed when investing. And again, everything I'm saying is from personal experience and my own personal risk tolerance. So greed and the amount of greed will be relative to each of you. But this is just what worked for me, so let's go with it. I remember reading an amazing book called Reminiscence of a Stock Operator, and it detailed the life of one of the greatest traders of all time, Jesse Livermore. And one key takeaway that I learned from this book and his strategy was to let your winners run and to cut your losses short. So when your investments are losing money and they're kind of going against you, you want to cut those losses short and make sure to minimize your loss. Do not get greedy at this point and try to hold out hoping to make that money back. From my personal experience, and when I got into losing trades and I didn't get out, the losses just kept going and going and going and going. So just do yourself a favor and just cut those losses immediately. Now, on the other hand, when you're in winning trades, when you get into an investment and you're making money and you have gains, you want to let it ride. This is very important. You want to let the investment grow and mature and have time to do its thing. And again, this is going to be depending on the plan we made. Remember one of the steps that we talked about, make a plan? So make a plan beforehand. Maybe it's at 50%, maybe you hold out to 100%, whatever your personal risk tolerance is. But one important thing is to let it ride when it's going in your favor. This is how we're going to make bigger gains, and this is how we're going to make money in the markets. All right, I have used up all the angles possible for filming in this house, so I guess that means it's time for the bonus tip. So here it is, words of wisdom from Pandrea Finance, the hottest new channel on YouTube. Do not buy short-term options. Just don't do it. Don't buy short-term. You want to go and have your investments have time to make money. And in most cases, the larger profit gains from long-term moves will always outweigh short-term risky bets. The Wall Street bet phenomenon of crazy option plays expiring the next day and basically going to the roulette table, and you will lose money this way. And this is why options have somewhat of a bad stigma. When you hear about options, you're like, oh, I don't really like to take a lot of risks. But the truth is options could be a safe, reliable investment if we learn how to use them correctly. And that's what we plan to do on this channel. I'll do many more videos on options, and there's a lot that we have to learn. I would really appreciate a like on this video if you learned a thing or two. If you can, share it around, and let's get the word of this channel out there. Thank you so much for watching. My name is Alex Pandrea, and we'll see you on the next video. Peace.